Good evening, everyone. I am Amita Bissa, moderator of this webinar. We are delighted to welcome you all in the webinar being organized by CCLEA and NPO Committee of ICI. It is my pleasure to be a moderator in webinar on FEMA, Professional Opportunities for CAs on 19th Feb 2026, conducted between 5 p.m. to 7 p.m., being organized by Committee on Commercial Law, Economic Advisory, and NPO Cooperative of ICAI. In a short while, we will start the webinar. I would like to appraise you about CCLEA and NPA committee. This committee is focused to encourage chartered accountants to shape strategy and policy that unlocks economic, financial, and social values while combining analytical foresight with commercial acumen. One of the core areas of this committee is to serve the multifunctional task of analysis, knowledge dissemination, inputs to regulate on policy formulations, to develop and publish technical guidance, background materials, and to create awareness for professional opportunities for chartered accountants in commercial law, economic advisory, and NPO cooperatives. Our eminent speaker will talk on FEMA professional opportunities for CAs in this webinar. And it's my privilege to introduce today's eminent speaker, CA Niranjan Srivastava. He is a member of Institute of Chartered Accountants of India, having a vast experience of 17 years, and is founder of Niranjan Srivastava and Associates Chartered Accountants. He is having strong experience in taxation, both domestic and international, FEMA, and management consultancies. He has developed himself in advisory litigation and handling other commercial matters. He has handled various assignments of advisory litigations and compliances. Besides that, he is having a sound academic background and has successfully completed various certifications and diplomas courses of ICI post-qualification, such as Diploma in International Taxation, that is DIIT, certification on FEMA, on forensic accounting and fraud detection, concurrent audits of bank, and the current ongoing certification course on mediation. He has deliberated at various seminars and various portals and e-portals and has written various articles on FEMA. Let us have a privilege to listen to him today. Over to you, sir, on the talk of FEMA, professional opportunities for CAs.
Thank you so much, C. Amita, for this detailed introduction. And really, this is the wonderful things that we are present here to elaborate. First of all, I would like to thank you, the Committee on Commercial Law, Economic Advisory, and NPO Cooperatives for giving me this opportunity to speak on this webinar. And now I would like to share my screen so that we can share the PPTs. Please confirm it is visible for everyone.
Yeah, it is visible, sir.
Okay. My voice is also clear for everyone.
Yeah.
So FEMA, it's a very specific law which is regulated by the RBI, and various opportunities for the CA, which is untapped, and most of the CAs are not even aware or even aware. So they don't find it easy and not friendly. So they do not go into this kind of practices, and they normally try to escape this kind of topics. So today we'll discuss entire things, and definitely which will help you to definitely it will help you to away from the fears and make the very friendly for the FEMA. So What is the objective and scope of the FEMA? First, we will discuss about this and how it is regulated. So, regulate foreign exchange transactions in India according as per the FEMA Act. Facilitate external trade and payments, which was normally the export import of goods and services. Conservation of foreign exchange, which are its highest conservation. We always listen in the news. FDI is coming and our forex reserve is growing day by day. So this is also the part of the FEMA. Ensure orderly development of foreign exchange market. FEMA applies to whole of India and branches, offices and agency outside India controlled by the person resident in India. So even one person who is opened their branches or offices outside India, they have opened their any agencies outside India, which is controlled by a person who is resident in India, that there also equally FEMA will be applicable even on the foreign branches, which is situated outside India. Export and import of currency. Apart from the goods and services, even current export and import of the currency is also regulated by the Forex FEMA. Regulatory and compliance framework. So whatever the transactions is made, for that we have to do the compliance work and regulate under the regulatory framework. So that is also defined under the FEMA Act. Enforcement and adjudication. If any contravention is made, then adjudication uh, will be applicable. If any mistakes are made, then also under the adjudication, we apply for the uh, compliance regulations. What is the key regulatory framework under the FEMA? If we will talk about the whole of the foreign exchange regulatory management, so that is the nodal agency is the RBI, Reserve Bank of India, who is regulated this FEMA. But only FEMA Act is not the sufficient. If we will talk about the overall foreign exchange transactions regulations, so it will be combined of the all includes Foreign Exchange Management Act 1999, which is passed by the Parliament, Foreign Exchange Management Regulation, which is issued by the RBI time to time, Foreign Exchange Management Rules, which is notified by the central government, Master Directions, Master Circulars, Notifications, Circular DIR series and FAQ also. It all was issued by the RBI time to time. So if we are going for the any transactions which is permissible under the FEMA or not, so we have to check entire the things, act, regulations, rules, master directions, circulars for the any updates given by the RBI. So entire things we need to check out before deciding for the any transactions and what will be the impact over there. So these are key regulations framework we need to keep in the mind before going into enter any transactions. And the most important things is the why FEMA matter for the chartered accountants, which the main topic for today webinar. What is the opportunity? So opportunities also include the why matter these things because growing cross-border transactions day by day, FDI is coming in the India. Government has also the lots of planning for the FDI. FDI is the more discussion point in the India, but ODI is the equally important. ODI is also growing day by day, which is Indian businessman, Indian investors is investing outside India and making their the subsidiaries and other entities outside India. So ODI is equally important to the FDI. Untapped market potential. Very few professionals are involved in this field. Even CA or other than CA, some company secretaries, professionals are also involved in this, but very less professionals are giving the services to this field. Very few consultant and specialists available at present. Even person who are giving the services, they never feel they are expert in this field or specialized. So they are giving the providing the services, but most of the topic, they are also not clear about that. So this is the very good opportunity for the chartered accountants. Huge demand for the professionals because business is growing, cross-border transactions is growing. So logically, demand of the professionals will be also growing simultaneously. What is the right and specification given for the CAs? That is the certification criteria. CAs has right to issue the certification for the valuation purposes to the FDI, ODI, and ECB related compliance. Lack of in-depth knowledge of the subject. So most of the people, as I said, they are doing the work, but they don't have the deep knowledge. Many time on the many topics, they don't have the even clarity. Increased scrutiny by the RBI and AD Bank. So earlier it was very lesser strict review by the RBI or AD Bank, but now they are strictly they are reviewing very strictly entire things. Even single form, whatever the filing is going on, AD Bank first has to check and verify the things, then forward it to the RBI. AD Bank is the authorized dealer bank, which is designated by the RBI. So they are the first reporting point authority, and we have to file the forms with the AD Bank. Then AD Bank will verify, cross check, and then it will forward it to the RBI for the confirmation. Fear or unknown and AD. So of course, if any person do not have the clarity on the any topic, they will fear from that topic. And AD is the name of the fear. You can easily understand that. ED has the major role in the FEMA related transactions. If any transactions is considered as a money laundering, they are not regulated through the proper FEMA channel as prescribed under the FEMA law, then the ED will come under the picture. You can say in the single word, ED is the police uh, authority for the RBI. Like if you are doing some criminal activity in the any state, so state police will be deal with you. So if you are doing any contravention with the RBI regulations or FEMA regulations and money laundering is involved, then ED will be handled with you. So this is a very clear thing. So whenever the ED name is came, person will fear mostly. So these kind of things we have to upgrade in ourselves, and lots of opportunities there. So we can grow uh, as compared to the other professionals in the deep manner because we have the lots of clarity over the laws and regulations as we are dealing by day on the other regulations and like income tax and GST law. So chartered accountants can easily understand and they can prepare for themselves for their growth in the FEMA field of the practices. Statutory recognition under the opportunity under the FEMA. So certification is required by the chartered accountant under the FDI, ODI, ECB, LRS. LRS is a liberalized remittance scheme, which was deal under the deal by the individuals. Form APR, Form ODI, Form 15 CACB. I can easily understand lots of professionals are issuing Form 15 CBCA on the regular basis, and they are very familiar with this. Net worth and financial certificates. These are also the area where CS certification is required, and we have the opportunity to issue the certificates on the regular basis. Valuation of shares. Whenever the any person is taking going for the investment in the any entity or any LLPs or any companies, or even he is going for the step down from the that companies or from the LLP, the valuation certificate of their share value is also required, which can be issued by the chartered accountant and cost accountant and or by the merchant banker. Largely, a scope is available for the chartered accountants because already The clients are associated with the chartered accountants and they are easily approachable. And one more thing also I would like to share with you all that for the listed companies, earlier it was certification was authorized for the chartered accountant, cost accountant, and merchant banking by the SEBI. But last few months back, SEBI has withdrawn the merchant banker name from that list. So the for the chartered accountants, the scope has also gone broad for the issue of the valuation certificates. Advisory in respect of FEMA compliance, FLA return preparation. So we have also the lots of scope for the advisory and compliance purposes. FLA and APR, it's a annual return, which is also the opportunity for the CH for the filing, the FLA returns preparation. Compounding and presentation before RBI. So as we all are representing the clients to the other agencies, we have also opportunity here to represent before the RBI. Compounding processes is the very voluntary process. We will discuss later in the details. But everywhere, lots of opportunity we have to do for the clients. First of all, we'd like to give some snapshots over the FEMA history. Foreign Exchange Management Act, FEMA Exchange Control led to introduced by the Britishers in 1939. So in India, foreign exchange control was established even before the independence. In the 1939, when Second World War was started, that time even Britishers have realized that world order is being changed and foreign exchange, whatever the cross-border transaction is being made, so we need to preserve the foreign exchange. So the first time foreign exchange control was introduced in the 1939. Post independence, the FERA 1947 was enacted after India gained the independence. But that time there was no lots of experience or knowledge regarding this act. So, on the basis of assumptions, they framed the 1947 laws and enacted after the independence. In 1973, FERA was revised. An updated version of the FEMA, updated version of the FERA 1947 was enacted after taking into account of the experience gained under the earlier law, evolving economic expectations, and the anticipated challenges of the changing foreign exchange environment. So during the revision of the FERA in the 1973, lots of challenges were there, and for the controlling the foreign exchange, they made very strict law in the 1973, and lots of the provision, you can say the most of the provision was made as a criminal activity. If you are making the any contravention related to the FERA 1973, that will be considered as a criminal activity, and you will be punishable with the imprisonment. So the main motive was to regulate the foreign exchange, not the manage. And due to this reason, they are restricted provisions was given under the FERA 1973. FERA 1973 came into effect from the 1st January 1974. Its main objective was to control, conserve, and regulate foreign exchange. ED administrator administered the law enforcement. So that time the ED was also inserted under the FERA. FERA introduced a strict penalty and criminal charges for the violations. As violation of FERA was considered a criminal act and there were major penalties associated with it. So it also creates fears under the people because even the minor mistakes, under the mistakes, people will get arrested. So that was also the fear for the people who are dealing in the foreign exchange. So due to this reason, FEMA 1999 was revised uh, and replaced the FERA 1973 to regulate and manage the foreign exchange. So basic difference was the FERA 1973 and the FEMA. That was the control and regulation, and here is the management of the foreign exchange. This deals with the transaction between the person resident outside India and person resident in India. So whatever the cross-border transaction is being made, so FEMA regulated under this. They also bring the all transactions divided into the two part: current account transaction and capital account transactions. So this will give the easiest recognition and transparency in the transactions. They also give the two routes available for the automatic and approval route. So there is no confusion. Either it will be covered under the approval route or automatic route. Regulation, circulation, circulars, notification, and press release provides procedural aspects, as I already discussed with you. Whenever we talks about the FEMA, so we have to look out the entire things, including act, regulations, rules, notifications, matter directions, FAQ, etc. It's monitored by the RBI and enforced by the ED. Non-compliance attract penalties. So if you are making any non-compliance, you have to pay some penalty. Earlier, it was the only one route through the compounding process, but now they have also introduced the LSFA scheme. So late submission fees through some contraventions or late submission of the forms, you can also go through the LSF mode and pay the excess fees and can file your the form even after the due dates. One thing I also like to clear that under the FEMA, this is very clear that if any transactions is not permitted directly, you cannot do the indirectly also. So this is the very clear things. Like other act, we cannot make the planning in this and cannot divert or do the indirect through the indirect route anything. So if it is not permitted directly, it is also not permitted indirectly. It is very clear under the FEMA. If you talk about the FEMA Act, it is a very concise and a small act. Only 49 sections is there total. Section 2 is talks about definitions. Section 3 to 9 talks about the basic concepts of the regulations and the management. Section 2C and Section 10 to 12, it's talk about authorized dealer, which we talked earlier, which was referring the AD bank. So authorized dealer bank. So this is also comes under here, under the section 10 to 12. Under this provision, RBI has power to authorize the person to act as a authorized dealer. Section 13 to 15, it's talk about the contravention and penalties. Section 16 to 35 talks about the adjudication and appeal. If any contravention has been made or RBI has issued the any notice, then you can go for the adjudication and appeals. Section 36 to 38 talks about the enforcement directorate. That is, we are talking about the as a ED, what will do and how it will do. Section 39 to 49, it's a miscellaneous provision and give only for the regulatory compliances and our ED, how will set up, how they will perform, what will be their the remuneration and allowances. So this kind of miscellaneous things is there. Some sections which are important to discuss here. Section 46 authorize and give the power to the central government to make the rules. Section 47 of the FEMA Act, which gives power to the RBI to make the regulations by notification. Regulations are issued by the notifications, but also they have to let down before the parliament whenever the session is coming. If any regulations is issued by the RBI, they have to lay down that regulation before the parliament also. Section 48, these rules and regulations to be placed before parliament. Section 48, it's also giving the compulsions. Get authority equivalent to an act and it is passed by the parliament. So once they will rectify by the parliament, it will be become equivalent to the act. Regulations are instruments by which the power to make substantive law is exercised. Rules are the instrument which the power to make law about procedure is established. So whatever the basic difference, if you will talk about the regulations and rules, so regulations is defined what you can do under the FEMA and what you can't do under the FEMA. Rules is prescribed if you can do how you have to do. So this is the difference between the regulations and the rules. Regulations are of wider import scope, much broader than the rules. So they have categorically a specification given under the regulations so that you can decide what you can do or what you can't do. Once you decide what you can do, you can refer the rules for the how we should do. If they are revised, it carries the same number, our original, but we have to give the R marks so that we can recognize easily that is the revised version and along with the year which they have published. So this is kind of the regulatory framework we discussed here. Some FEMA major regulations we will also discuss on the actually regulations is issued by the RBI topic wise. So they have issued many regulations, but we have to mention some major regulations which broadly used on the day-to-day transactions. So permissible capital account transactions. We will talk about the capital account transactions and current account transactions. Earlier, as we discussed, all the transactions has been broadly divided into two parts. One is the current account transactions and second is the capital account transactions. So current account transactions is simple if it is not prohibited unless otherwise it is prohibited by the RBI or central government. It is the freely uh, it is the freely transactional transactions. So all the current account transactions as permitted transactions unless otherwise it is prohibited. It's a simple things. And for the capital account transactions, it's a simple code line. Unless otherwise it is permitted, it is a prohibited transaction. So capital account transactions are the prohibited transactions unless otherwise it is permitted. So these broad things we need to keep in the mind. Unless otherwise prohibited, all the current account transactions are permitted transactions. Unless otherwise permitted, all the capital account transactions are prohibited. Borrowing or lending in rupees, they have also given the regulations over there, and it is also revised and final notification has came the even last week also for the lending and borrowing ECB related things. Deposits, acquisition and transfer of immovable property outside India, realization, repatriation and surrender of foreign exchange, possession and retention of foreign currency, remittance of assets, non-debt rule. We normally use this NDI rules. Transfer of issue of security by person resident outside India, acquisition and transfer of immovable property in India by the person resident outside India. So these are the major regulations on which we will discuss about these things. Some major rules are also defined here. So FEMA is designed to consolidate and modify law pertaining to the foreign exchange. Under Section 46 of this Act, there exists a provision granting the government to authority to formulate rules for the effective implementation of the act and to ensure compliance with its provision. So under this section, under section 46 has given the right and central government has notified some of the rules. According to Article 13(3)(a) of the Constitution, the rules are considered to have the effect of law. So our constitution has also given the rights so that all the rules will be equivalent to the act. While rule outline the procedural aspect of law, they cannot contradict the act, although there can be modified. So if we any contradiction between the rule or act, so definitely act will be prevail over the rules if any contradiction is there. But later rule can be modified and can be aligned with the act also. Some of the important rules notified under this act is the current account transactions rules. So as we have already said, current account transaction is freely permitted transactions unless otherwise it is prohibited. So they have given some schedules 1, 2, 3, where they have given some restrictions and they have given some permission with the a specific approval with the RBI or central government. So they have defined under the current account transactions rule 2000, NDI rules 2019, which is the very important rules. Through this compliance, only all the FDI are is coming, and government is also very sincere and looking forward to making its NDI rules to the user friendly and investor friendly. So if you can remember, even during the budget speech, our honorable finance minister has also referred that they have made the comprehensive, they have made the arrangement for the comprehensive looking through the NDI rules, and they will enhance the and revise this NDI rules for the making more user friendly, of course. So during this budget, 2026 was also uh, it was given under the budget speech, and they will comprehensive review the existing rules, NDI rules, and they will make some user-friendly changes also. Overseas investment rule, as I earlier said, FDI is the very common things, and everyone is very familiar with this. But ODI, overseas investment, is also equally important and equally rising day by day. So that overseas investment rule is 2022. Compounding proceeding rules 2024. So if any contravention is being made, then we have to go for the compounding process. So these are the important rules given under the FEMA rules. What is the status of person? So if any person is doing the transactions in the foreign exchange, first we have to decide there the residential status. What is the status? And I also like to clarify that the person residential status under the FEMA, and we normally use the residential status under the Income Tax Act. Both are the totally different. Under the Income Tax Act, one person can be resident or non-resident during the financial year. Under the FEMA, one person can be resident on the particular date and even can be non-resident on the other particular date, even during a financial year. So both are the totally different. We have to look here from the different angle. So under the FEMA, status of the person resident in India and person resident outside India. They have broadly divided into the two parts. Either it will be resident in India or resident outside India. Once person becomes the resident outside India, they have given the three categories. Non-resident Indian, NRI, means a person who is born under the India or their parents or grandparents has born under the undivided India. It means India, Pakistan or Bangladesh. So they can be called as a non-resident Indian. Non-resident Indian. Overseas citizen of India. Earlier person of Indian origin. Normally we use this term, but now we called as an OCI card holder. We normally listen these things. So overseas citizen of India. So person who was earlier the citizen of India, but now he has left out the citizenship, dropped their citizenship of the India and acquired the another citizenship on the any other foreign country. That person is eligible to apply and acquire the overseas citizen of India card. So that is also their roots are also belongs to the India, that overseas citizen of India. And third is the pure foreign citizens who have there is no roots in India. So that cover all three under the person resident outside India. Person resident in India. So person resident in India means a person residing in India for more than 182 days during the course of the preceding financial year, but does not include a person who has gone out of India or who stay outside India in either case for the taking up employment outside India or for carrying on outside India a business or vocation outside India. So if you will see here and you will compare with the Income Tax Act, you will find some similar things. But the C point is the very crucial here. For any other purpose, in such circumstances, as would indicate his intention to stay outside India for an uncertain period. So here this word is intention is the very important things. So even a person who is going outside India with intention for the uncertain period to stay the outside India, he will become the non-resident immediately after that. So intention is the crucial things. Even the person has gone the last day of the financial year to outside India, and his intention is stay for the uncertain period to the outside India, he will become the non-resident. A person who has come to our start stay in India in either case, otherwise than for taking up employment or carrying on a business in India or vocation in India for any other purpose in such circumstances and indicate his intention to stay in India for uncertain period. So here is also mentioned that if any foreign citizens is coming in India and their intention to stay in India for an uncertain period, so he will become the resident immediately on this basis. Any person or body corporate registered or incorporated in India that will also always considered as the resident of India, any company or any other body corporate which is incorporated. An office, branch, or agency in India owned or controlled by a person resident outside India. So, if any branch of the foreign company, any project office, or any other agencies of the any foreign company which is situated in the India, it will always be considered as a resident in India, or any office, branch, or agency situated outside India, owned or controlled by a person resident in India. So, if any Indian company who have set up their branches or they have opened their any offices outside India, which is controlled from the India, will also be treated as person resident in India, even though it is situated outside India. Overseas citizen of the India. So who will be the overseas citizen of India? But it will be covered under the person resident outside India, as we discussed earlier. So individual resident outside India who is registered as a overseas citizen of India card holder under Section 7A of the Citizenship Act 1955. We have the Citizenship Act. According to that Act, Section 7A has defined the overseas citizen of India. So under Citizenship Act 1995, person eligible under the above to become the citizen of India, child or grandchild of citizen of India. So as we discussed, any person who is born under the undivided India, that person or their child or their grandchild means ki third generation is also eligible for getting the overseas citizen of India card, and they are eligible to apply under the Citizenship Act. Minor child of a parent, where any parents is a citizen of India, they are also eligible to apply for the OCI card, even the minor child. Foreign spouse of the citizen of India, even if any person has surrendered their the citizenship of India, but now they are the OCI card holder, they have married with the foreign citizens, they can also apply for the citizenship OCI card. The condition is that that marriage to be sustained for the continuous period of the 2 years. Then they can only apply for the overseas citizen of the India card. What is the current account transactions? So current account transactions means a transactions other than a capital account transactions and without prejudice to the generality of the foregoing such transactions. So what is the capital account transactions? So can we say that like here mentioned means capital account transactions other than a current account transactions? Is it like that? Answer is no. So they have defined the capital account transactions and whatever the not the cover under the capital account transactions that will be covered under the current account transactions. So here simply they have mentioned that the current account transactions mean transactions other than capital account transactions. So payment due in connection with the foreign trade, other current business services, and short-term banking and credit facilities in ordinary course of the business. This is kind of example of the current account transactions. So whatever we are making the export from here or bringing the import from outside India, that all will be covered under the current account transactions. Any services is being provided, so that will also be covered under the current account transactions. If any person is making the remittance to their relatives who are residing outside India, or any student is going outside India, they are making the remittance for their studies, that all will be covered under the current account transactions. Payment due as interest on loan and as a net income from the investment. So interest is also the recurring kind of the nature that will also cover under the current account transactions. Remittance for living expense of the parents, spouse, and children residing abroad. Expense in connection with the foreign travel, education, and medical care of the parents, spouse, and children. If you are going for the vacation outside India, that all will be covered under the current account transactions. Current account transactions is defined under the section 5 and they have given the definitions here. Any person may sell or draw foreign exchange to the to or from an authorized person if such sale or drawal is current account transactions. So authorized person, they have given defined under section 10, who will be the authorized person. RBI has the power to make the person as a authorized person give the license to operate like AD Bank or even full-fledged money changer we call FFMC. They are all covered under the authorized person. They have the authority to deal under the foreign exchange term, foreign exchange. They can buy the foreign exchange, they can sell the foreign exchange, they can issue and receive the traveler checks, etc. So any person may sell or draw foreign exchange to or from the authorized person. Such sale or withdrawal is a current account transactions, provided that the central government may, in the public interest and in the consultation with the RBI, impose such reasonable restrictions for the current account transactions. As I discussed, all the current account transactions are the permitted transactions unless otherwise it is prohibited. So they have given some restrictions also over the some kind of transactions due to some their nature. But unless otherwise prohibited, all the current account transactions will be covered under the permitted transactions. What is the capital account transaction? So they have defined the capital account under section 2E. Capital account transactions mean transactions which alter the assets and our liabilities, including contingent liabilities outside India of a person resident in India, or asset or liabilities in India of a person resident outside India. So earlier we see the current account definitions. They have simply mentioned that all the transactions other than the capital account transactions. Here they have defined the capital account transactions. So all the transactions which alter the assets or liabilities of your uh, and who is person the resident in India and any person who is outside India, their assets and liability. We can, as a chartered accountant, we all are the very familiar with this kind of things. So we can easily identify which transactions is affecting the and altering the our assets or liabilities. Simply all the transactions we are directly affecting our the balance sheet portion that is all covered under the assets and liabilities. and whatever the transactions which directly impacting our the profit and loss, that we can be considered as a uh, current account transactions on the broad base. It can be some, it can be few exception also. There is not an issue. So capital account transactions, they have also defined under the section 6 as we discussed. Capital account transactions are the prohibited transactions unless otherwise it is permitted. So it is here also mentioned. The Reserve Bank may, in consultation with the central bank, specify any classes or classes of capital account transactions not involving debt instrument which are permissible, the limit up to which foreign exchange shall be admissible to such transactions, any conditions which may be placed on such transaction. So they have also issued some list which are permitted, even the capital account transactions, but RBI has already given the permission list. It means they will cover under the approval route. So you don't give to go for the take the permission, even though you are doing the capital account transactions, which is specified by the RBI. So what is the current versus capital account transactions? If you will see here, the what is the current account and capital account. The core value is the trade in goods and services, income and transfers that is covered under the current account. Foreign investment and borrowing like FDI, ODI, ECB all cover under the capital account transactions. If you talk about the nature, income and consumption flow cover under the current account transactions. All the whatever the income and expense has been made through the foreign exchange, even the country at their level, they also consider these things. Assets and liability creations. So if you are bringing the ECB from the outside India, so that will create the liability over the nation. If you are investing outside India, buying some properties, it will create the assets. What will be the impact of this? Reflect total net income of the country in a year under the current account transactions. So whatever the export you have made and remittance have been realized, or whatever the import you have bring and make the payments against that import. So total net income and expenditure. After that, the total income of the country will be the impact. Due to this reason, RBI is monitoring all the forex transactions because overall the nation, the impact on the nation has been effect. Reflects net changes in the country's assets under the capital account transactions. If you talk about the component, so under the current account, export, import of the goods and services, current transfers, uh, this will be the component of the current account transactions. Under the capital account transactions, FDI, FPI, ECB, government loans, this will be the capital account component. Evaluations help in finding the trade deficit surplus of the country. We always hear about the uh, country with whom we are making the trade deals. So now we are the very hot topic also, which are we are finalizing the trade deals with the many countries. So we always hear and talk about the trade deficit. So trade deficit and trade surplus, it all cover under the current account. And under the capital account, whatever the investment is coming and as a FDI and whatever the investment is going outside India under the ODI, so that determine in the net investment of the country, how much foreign exchange came and how much has gone out. So on that basis, we decide the net investment of the country. So this cover under the capital account transactions. Policy sensitive, if you talk about, so whatever under the current account transactions, if you are the normal trade deal, the structural reform is required, like the duty enhancements or making the imposition of the some kind of goods which will not be traded freely. So this kind of structural reform is made under the current account transactions. For the capital account, monetary and capital controls requirements made for the capital account transactions. So this kind of the policy sensitive steps taken by the central government for regulate all the transactions which is affecting through the cross border. What is the objective? So under the current account transactions, main concern with the receipts and payment of the cash and non-cash, non-capital items. So if we make the more payment and receive the less payment, our capital reserve will impacted. So we have to make the balance of that forex reserve also. So that is the main objective under the current account. And for the capital account transaction, main concern with the source and utilization of the capital items. So this is the broad difference on over the business entity or as a whole over the country, how it is impacting overall the country also. So we can see and we can get the clarity over here also. Why government is so strict and so concerned over all these transactions and why they are monitoring and regulating on the continuous basis. Major roles of RBI and AD banks. So what they perform physically. So as we said, RBI is a nodal agency and they are regulating, making the framework. So they have the roles to make the policy formulations and regulations. Approve authority, they have the power to authorize the person to act as a authorized person, like authorized dealer, like popular money changer or any agencies. So they have the power to approve as a authority. Supervision and oversight. So if they have given some authority, they have to supervise if they are they are doing their function on the uh, as expected basis or not. They are properly giving. They are properly doing their work according to the framework given by the RBI or not. So they have to supervise and oversight. Enforcement power, they have also the enforcement power. So if any agency is not complying with the rules and regulations framed by the RBI, they can enforcely uh, make some changes in their the governance structures. They can also forcefully retire some officers of the seniors levels. This kind of enforcement, they can also supersede and they can immediately seize the power. They have this kind of power under the RBI. They use as a enforcement power. Delegates of power. Uh, if RBI authorizing the AD bank and giving some power to regulate with the to to contact with the to deal with the business entities on the direct basis and they are all the instruction giving to the business organization. They can also deal with the authorized dealer on the direct basis. So this is covered under the delegation of power. So RBI just uh, providing some their power to the other agency. They can perform on behalf of the RBI under the rules and regulation framed or and guideline given by the RBI. So that is covered under the delegation of power. So what is the power of the AD bank? They are also covered under the delegated agencies as RBI given some delegations to the authorized dealer bank. Execution of FEMA transactions. So AD bank has the first transactioning authority. AD bank has to directly deal with the business entity. Business person can not go for the every uh, concern to the RBI directly. First, they have to approach with the AD bank. So AD bank has the power to execution of the FEMA transactions, opening and maintenance of bank account, approval and certification as delegated authority. They are doing this, monitoring and reporting. So lots of compliance has delegated by the RBI to the AD bank and they are performing on their behalf. Once the AD bank will satisfy whatever the process is being followed by the any business entity, only then they can forward it to the RBI. Otherwise, they will desist from the doing transactions. They will deny your foreign exchange transactions. And they will not permit you. So this kind of act done by the authorized dealer bank. Some substantive provisions dealing in the foreign exchange defined under the section 3. So if you will see here, it's a straightforward denied that save as otherwise provided in the act, rules or regulations made thereunder, or with the general or special permission of the Reserve Bank, no person shall deal in our transfer any foreign exchange or foreign security or any person not being an authorized person. So authorized person definitions is covered under section 10. So other than the authorized person, no person has right to deal in the foreign exchange. And one thing is very clear. Normally, person thinks that if any person is doing some business transactions, then FEMA will be only applicable. But here is the myth. Even you are doing some personal transactions for the under the foreign exchange, you are dealing in the any mode for the any purposes, even for the personal purpose or for the business purposes, dealing in the foreign exchange, the FEMA will be equally applicable to you. So this provision is straightforward, doing saying these things only. Other than the person, authorized person, which are covered under section 10, no person will deal in the foreign exchange. Make any payment or any credit of any person resident outside India in any manner. Receive otherwise through an authorized person any payment by order or on behalf of any person resident outside India. So no person will deal other than the authorized person. Whatever the any business entity or any individual they wanted to do in the foreign exchange, they have to go through the authorized person. Authorized person cover the authorized dealer bank for a full-fledged money changer. So this kind of person you have to contact with them, and through that only you can make any foreign exchange transactions. They have also given the explanation for this. For the purpose of this clause, where any person in our resident in receives any payment by order on behalf of the any person resident outside India through any other person, including without a corresponding inward remittance from any place outside India, then such person shall be deemed to have received such payment otherwise than through an authorized person. So if you are bringing any payment through the any other person, which was not the coming through the banking channel or authorized through the authorized person, that will be treated as violation of the FEMA Act. Enter into any financial transactions in India as consideration for or in association with acquisition or creation or transfer of right to acquire any asset outside India by any person. So simply it is saying that whatever the financial transactions is being made, it should be uh, done through the legal banking channel, through the authorized person only. Apart from that, if you are making any transactions, that will be covered under the contravention of the FEMA, and accordingly the compliance will be applicable. And here the minimum penalty for the contravention of the FEMA is the three times of the amount involved. So if you are making the any payment, suppose through the not legal channel for the $1 lakh, so your penalty will be increased to the $3 lakh. It's a three times of the amount involved. So you have to be very careful here. Holding of the foreign exchange, section 4 divided, save and otherwise provided in this act. No person resident in India shall acquire, hold, own, possess, or transfer any foreign exchange, foreign security, or any immovable property situated outside India. So if you are a person resident in India, so you have to keep on those things. If any even foreign exchange realized by you from the outside India, you have to repatriate to the India as per the FEMA rule prescribed under this act. We will discuss later. Realization and repatriation, it is defined under Section 8. So any amount of foreign exchange is due or has accrued or any person resident in India, such person shall take all reasonable steps to realize and repatriate to India such foreign exchange within such period and in such manner as may be specified by the RBI. So this is talking about the all transactions. Even you are making the export, you are making the services export, or any kind of things you have realized you have invested there, you are getting the profit over there, you are getting interest or dividend. So entire things you have to be repatriated and repatriated and surrendered to the India according to the Section 8. They have prescribed the time framework also. So under the every transactions, they have given the different kind of time frame. Like the for the export of goods, you have the 15 months time. Accordingly, for the different transactions, they have given the different time framework. But definitely, you have to ensure that it's your responsibility to repatriate all the realized amount outside India. If amount is not realized within the prescribed time frame, you have to report the RBI through AD uh, giving the actual reason why you have not realized that payment and what will be the expected time for the realization. Foreign exchange definitions given under the section 2N. So what is the foreign exchange means? Foreign currency and include payable in any foreign currency, deposit, credit, balance payable in any foreign currency, draft, traveler checks, letter of credit or bill of exchange expressed or drawn in Indian currency, but payable in any foreign currency. So simply, whatever the transactions making other than the INR, even in form of the cash or in form of the draft checks or anything in which the foreign currency is involved, that will be considered as a foreign exchange. So under this definition, it all will be covered. So even we are dealing on the currency or through the checks or through the draft, we have to keep in the mind all the foreign exchange regulation will be applicable over equally. Foreign security. What is the foreign security? Like we all familiar that any shares, stocks, bonds, debenture, or any other instrument dominated or expressed in foreign currency and include securities expressed in the foreign currency, but where redemption of any form of return such as interest or dividend is payable in Indian currency. So that all security will be considered as a foreign security on which the FEMA is equally applicable because that is drawn under the foreign currency. So repatriation to India has also defined under section 2Y, and that definition is simply selling of such foreign exchange to an authorized person in India in exchange of the rupees. So whatever you have the foreign exchange you are bringing from the outside India, you have to sell that foreign exchange to the authorized person once in. Who is the authorized person? That is defined under section 10. So you have to sell the any only to the authorized person. The holding of realized amount into an account with an authorized person in India to the extent notified by the RBI and include use of the realized amount for the discharge of a debt or liability denominated in foreign exchange and expression repatriation shall be constituted accordingly. So item cover those export earner foreign currency account, EEFC or RFC account. So even you have received the amount in your EEFC account or RFC account, then you don't need to sell that amount to the authorized person because they have that account is governed by the specific rule. If you will leave some unutilized amount and will not convert under the INR, after a certain period, that amount will automatically convert into the INR. So if you are bringing the foreign exchange and depositing in your EFC account or RFC account, then you no need to sell out this amount to the authorized person. Apart from that, whatever you have any the foreign exchange, you have to uh, sell out to the authorized person. Only uh, coins you can keep with you, and up to the 2000 USD, they have given some relaxation and also given some permission to the individuals. You can keep with you for your purposes. If suppose you are going for the foreign trip, you have buy some foreign exchange, and after returning, you have some unspent foreign currencies, which you supposed to sell to the return to the authorized person. But just you contacted by your friend or your any family member or your relative, they are planning to go for the vacation abroad. So can you give and hand over that foreign exchange to that person for their utilization? The answer is no. You have to return or sell that foreign exchange to the authorized person only. You cannot pass to your relatives or any friends, because you are not authorized to give or forward that foreign exchange to the any other person other than the authorized person, and that person is need to purchase from the authorized dealer only. Otherwise, it will be covered under the contravention. So these we also keep in the mind. In the friendly way, we normally just give to our family members or friends to utilize that unspent amount. Permissible current account transactions. So as we discussed, what all the current account transactions are the permissible current account transactions unless otherwise it is prohibited. So they have given some nature of transactions and defined under the three schedules. So whatever the transactions given under the schedule one, it is the prohibited transactions. So that transactions cannot be happen anyhow. Under the schedule two, they have given some list, which is the restricted list with the central government permission. So you can do that transactions, but you need to take the permission before doing that transactions from the central government. So we can consider as a approval route. Although this cover under the current account transactions, but they have divided under the cover under the approval route. So first you need to take the permission from central government. Under the schedule C, they have given some list. Their limits has been prescribed. So under that limit, you can do your transactions freely. That will be covered under the automatic route. But if you are crossing that limit, that ceiling limits of the amount, then you have to take the permission from the RBI. That will be covered under the after that ceiling under the approval. So maintenance of close relative to be as per LRS scheme. As we all know, LRS is the liberalized remittance scheme. Under this scheme, all the individuals has the limits of 2,50,000 USD for every year. They can remit that much amount without any getting any kind of permissions. They can use and utilize up to $250,000 without any prior approval. Gift from the resident to non-resident to be covered under the LRS. That will all the transactions will be covered under the LRS. Medical expense, as per estimate from the hospital, if you are going for the any medical emergency for the medical treatment to outside India, even if the amount is exceeding from the $250,000, if the foreign hospitals has given the estimates on that basis, you can also take the higher limits of the amount without taking the special approval from the RBI or central government. If a student going outside India, and their educational expense is higher than the LRS limit, means more than the $250,000, on the basis of the university details they prescribe, they can also use the upper limit more than the 250,000 without taking the any prior approval from the RBI. Consultancy fees not exceeding USD $10 lakh per project. This is the specific infra related project. And for the other sites, if you talk about the other selling projects, if you are making the consultancy from the outside India, then it will be the not more than the 5% of the project cost. So this is the specific industry related ceiling limits. Capital account transactions, as we discussed, all the capital account transactions are the prohibited transactions unless otherwise it is permitted. So here they have given some permission. So regulations 31A, person resident in India are the authorized for this kind of transaction. Investment in foreign security. They can trade in any security which are listed outside India. Foreign currency loan raised in India and abroad. This is covered as a ECB, we formerly known as the external commercial borrowing. Transfer of immovable property outside India. If any person has any property outside India, either they have acquired during the non-residency period, or they have even get in the inheritance, they can also transfer. Guarantee issued in favor of person resident outside India. You can also give guarantee any person which is who are residing outside India. Loans and overdraft from a person resident outside India. Maintenance of foreign currency account, which was opened during the your non-residency period when you are staying outside India. You can keep maintaining that foreign currency account even after becoming the resident of India. Insurance policy outside India. You can also take the insurance policy from outside India. So these all are covered under the capital account transactions. All transactions, these are covered under the capital account transactions, but are permissible transactions. So you no need to go to the RBI or any other authority for take the special approval. So these are although capital account transactions, but are really permitted transactions. Likewise, they have also given some list for the person resident outside India. They wanted to do this kind of transactions, which cover under the capital account transactions in the India. So they can also do without any taking the prior approval from RBI or any other authority. So they can invest in India, issue of security by a company entity in India, invest in India, capital in form LLP. So basically, all these both are the cover under the FDI. Acquisition and transfer of immovable property in India. So subject to some conditions, like they cannot deal in the immovable property like the agricultural land or plantation land. So they have some restrictions, but other than they can even transfer the immovable property. Guarantee in favor of resident in India. Likewise, Indian person can give the guarantee for the outside person. The non-resident also can give the guarantee in favor of the any resident in India. Deposits foreign currency, remittance outside India as capital assets in India. Action to be taken by the person going outside India. So if any person who is resident in India but going outside India and their intention is to stay outside India for the uncertain period, for the for taking the employment, for doing the business, or for the uncertain stay, they immediately inform to the bank for changing their the account from saving to NRO or NRE account. Companies where shares held for the changing the status. Other investment where mutual funds, etc., you have made, that you need to inform that authority also, because that all will impact the other statutory compliances also. So whenever the company is giving dividend or the investment mutual funds is giving the dividend, they also have to comply with the other statutory law like income tax. They have to deduct the TDS. Bank has to also monitor the things. This person is resident or non-resident. On their interest, they have to deduct the TDS. So for the making the proper compliance, you need to inform all the agencies whenever you have to the concern you have investment or you are dealing with the financial agencies. So it will benefit to the person itself. Type of bank account for the non-resident, that following type of bank account they can maintain as their status is non-resident. So non-resident external account, non-resident ordinary account. So normally we used to say that NRE and NRO account. Foreign currency, non-resident account, is a non-resident rupee account. So SNRR. So out of four, the three account NRO, NRE, and SNRR, all three are the INR account, and one is the foreign currency NR account. In this case, NRO is considered as non-repatriable account. NRE is considered as a repatriable account. SNRR, the very limited purpose account. So that is only uses for the taking the refunds of the and the limited transactions. So they are the only used by the non-resident agency who are filing their income tax return, and they have to get the uh, a refund from the income tax department. So basically they use for the SNRR account. They are easily applicable. Interest on NRE and FCNR account is exempt from the income tax. NRE and FCNR balance are freely repatriable. Balance in NRO can be remitted under the 1 million scheme. So as I said, NRO is the non-repatriable, but 1 million condition scheme is applicable. So during the financial year, in a financial year, you can remit from the NRO account to NRE or any other account up to 1 million USD, not more than that. So this is the restrictions over the NRO account. NRE account is the freely transferable. You can make the unlimited from the NRE to any other account. Acquisition of property in India. Only NRI, POI allowed to acquire property in India. Agriculture, plantation, farmhouse not allowed by NRI. PIO, as PRIO we normally used to say, OCI. Foreign spouse of NRI or OCI can become joint holder, but only the condition is they have to keep the marriage for the continuous period of at least 2 years. A NRI POI can inherit agricultural property from a resident. NRI POI can sell existing agricultural property only to the resident. If any person they have received some agricultural property as in inheritance, they can sell that property to the resident person only. They cannot transfer to any person who are the not residents in India. Resident can give property other than agricultural to NRI or OCI. So other than the agricultural land, farmhouse, NRI can transfer to the any person who are not the person resident or any resident outside India or resident in India. There is no any restrictions over the transfers. NRI can gift any property to resident. So NRI giving the resident, there is no any war, but NRI giving to the another NRI, that is the restrictions. So we have to keep in mind. Now we will move forward to the FDI, foreign direct investment.
So
So
can we
foreign
take a
direct.
few questions? Some questions are popping up. Can we take or we take it at the end of the session?
So I will suggest if you will keep for the last of the session, we will be
Okay.
able to complete all slides. Otherwise, it will be very delay in our.
Okay, sir. We'll continue with your session. We'll take it later.
Okay, you can compile with that, and definitely I will take all the questions at the end of the session. Okay. So what is the foreign direct investment, SB? What is the key point? Eligible entity where investment can be made. So they have defined where you can make, like any companies or LLPs. You cannot make in the any FDI in the proprietorship business or any partnership form which is not registered. So they have given some criteria. Mode of remittance. So all the mode of the remittance bring coming from the outside India to the India, it will be through the legal banking channel. Sectoral cap. Sectoral cap means sector wise, they have given some caps, how much you can invest. In some sectors, you can invest at the 100%. In some sectors, you can invest up to the 74%. In some sectors, you can invest up to the 49% only. In some cap sectors, you can only invest up to the 25%. Whenever the cap is given and it's lesser than the 100%, it means you have to uh, make the collaboration with the any person who is resident in India, and with them only you can invest through the FDI. Where 100% is permitted, you no need to any person as a shareholder in the India, you can become the 100% shareholder of the company. Although other compliances of the Companies Act you have to comply, like the resident director or any other things. So, but under the sectoral cap, if 100% is there, you can become the 100% shareholder of that FDI company. Type of instrument for investment. So basically, equity has given our compulsory convertible equity, any debenture which is compulsory convertible, that all will be covered under the type of this. Valuation norms. So whatever the person is making the investment in the any existing company, then any share which will be issued to the non-resident shall not be the lower than the fair value of the market. How will valuation will be made? So as we discussed in the beginning of the session, chartered accountant is authorized to give the valuation certificates. Merchant banker and other companies, cost accountant is also equally authorized. So according to the valuation certificate, you have to decide the value of the share. Valuation norm is given. What will be the valuation norm? So any kind of uh, valuation method which is internationally accepted by the um, entities. So any method which is internationally accepted, you can use. Normally, they use the net asset value or DCF method. So accordingly, the valuation is done. Time limit for the compliance. They have also prescribed the time limit. If you are making the any payment in the Indian entity as a FDI, share certificates within the 60 days of the receiving the payment. They have also informed to the RBI through the form filing we called FCGPR within the 30 days of the allotment of the share. So this kind of the time limits has given for the compliance process and the compliance. So everything is defined under the FDI rules and FDI, sorry, NDI rules and NDI regulations. So what will be the process? Filing of the form to the RBI is online through RBI form portal. Entity user and business user need to create the RBI forms portal. Address of the website is forms.rbi.org. So through that you can access the website and you can create your the login ID, and after that you submit your form. So RBI has launched new filing single master file form SMF, where all the forms can be filed under one tab, which include FCGPR, FCTRS, LLP1, LLP2, Form CN, etc. It take one day to accept the login and confirmation. When if you are going for the new clients and making the new ID, it will take the 24-hour to approve that login ID, and after that you can start the filing compliance. On remittance from the investors, KYC from the remitting bank is required. The amount should be received in the convertible foreign exchange. Shares or instrument are the required to be allotted within the 60 days. So KYC and other the convertible, it all are done through the AD and this is the time limit prescribed. The share instrument required to be allotted within the 60 days after the receiving the payments. So who is the legible entity? So legible entity, as we discussed, company registered under the Companies Act, LLP under the under the certain circumstances. Which is the what is the circumstances? Whenever the 100% FDI is allowed in this sector, you can meet through the LLP. Otherwise, if any sectoral cap is there, then you have to go through the Companies Act also only. Partnership form is not allowed, but if partnership is registered, you can meet. Mode of the remittance, by inward remittance through banking channel, there are two routes, automatic and approval. We already discussed. So under the approval, you don't need to go for the any prior approval. Wherever is approval is there, you cannot go through the automatic route. You have to must take approval before the going forward. Type of instrument, equity share, compulsory convertible preference share, compulsory convertible debenture, debt instrument like redeemable debenture are not allowed under the FTA scheme. So only three kinds of uh, instrument is allowed: equity, our compulsory preference share, which will be converted under the equity, or any debenture which will be compulsory convertible under the equity. So ultimately, it will be considered as a equity under the FTA. Here is some prohibited sector where you cannot make the FDI, like lottery business, including government or private lottery, gambling and betting, trading in the transferable development right, in the TDR, manufacturing of cigarette, cigarette, this kind of tobacco related manufacturing, Nidhi company, real estate business, or construction of farmhouse. So these sector are all prohibited sectors, but real estate developer are allowed. So if you will look the real estate business list, so many categories are given the real estate business also. So some are allowed and some are prohibited. So like you can do the developer work or township development or uh, commercial premises, roads, bridges. So this kind of work you can involve through the REIT. Even you can invest in the real estate investment trust and real estate yes, in the real estate investment trust. So they have given the criteria under the real estate business. So if you will see the first line, you will look and you will assume as a real estate business is also prohibited, but they have given some categories where you can make investment through the FDI. FDI valuation are, as we shared with you, pricing guideline provided in the master directions, and price of the equity instrument should not be less than the price worked out with the SEBI guideline. If the entity is listed, it's a listed company, then you have to follow the SEBI guideline. Evaluation equity instrument done as per the internationally accepted pricing methodology. Any specific method is not mentioned by the RBI or under the regulations, but they have mentioned the internationally accepted pricing methodology, which normally used by and accepted by the internationally is the DCF or NAV, which is the frequently used. So I have also given example there. If the value of the share is 100 per share, company can allot the share any price 100 or above. You cannot issue the less than the fair price of the share. So that will be decided through the valuation certificate. Here are some forms given, like FCGPR at the time of issuing the instrument for the FDI, FTTRS, if any non-resident in transferring their shares to the any other person. LLP1, when you are investing in the LLP, through the FDI. LLP2 filed at the time of transfer of capital, contribution, profit sharing, or you are retiring from the LLP to the non-resident or any other person. Form CN, conversion notes to the non-resident person. It's a convertible notes. Form ESOP, if any existing company is issuing the share to their non-resident employee, they have to file the ESOP form and inform to the RBI. Similarly, DI, DIR, and investment. So these all forms are applicable whenever the transaction is made through the uh, non-resident and that are directly linked to the shares. ODI, as we discussed, ODI is equally important as equal to the FDI also. So overseas direct investment, ODI means acquisition of any unlisted equity capital or subscription as part of the memorandum of the association of the foreign entity. Investment in 10% or more of the paid up equity capital of the listed foreign entity or investment with the control where investment is less than the 10% of the paid up equity capital of a listed company. So these are covered under the ODI. Even once you invest and consider as a ODI, even after that, the investment is become lesser than the given limits, like the 10%. Then also it will be considered as a ODI. Means once a ODI, always it's a ODI. Even the your stake is become lesser than the prescribed limit. For investment in the subsidiary, joint venture or association, we make through the ODI. Financial commitment include pledge, guarantee, etc. So whatever we have the commitment for the making remittance from India to outside India, it all inclusive will be covered under the overseas investment. Bind investment in certain sector like real estate, trading in the TDR, similar like which was banned under the FDI, that is also banned under the ODI. All entities except proprietorship firm can invest. So other than proprietorship firm means including the partnership, LLP and company. But partnership should be registered partnership, not the simple partnership. Here is also given the some automatic and approval rule. Up to 400% of the net worth as per the latest audited financial statement, not older than the 18 months. You can make the automatic route. You can make the ODI under the automatic route. So even today, if you are in the month of February, we can use the previous year, which was from the 24-25 financial year audited financial statement to calculate the our net worth. That is audited. But if you want to make the more amount under the ODI, and we look if we are considering the our last audited balance sheet, that the total net worth up to the 400% will be not much, then we can make the fresh audit for the particular period for the special purpose audit. And accordingly, we can calculate our the net worth. Net worth includes share capital, reserves create out of profit, share premium. So this kind of things is included under the net worth. And also it is given under the Companies Act definitions under section 257. So this will be equally applicable here also. Overseas investment conditions cannot investment in the countries which are under the non-cooperative mode as per the FATF. So whenever we are deciding to invest in the any country, first we need to check with the FAFT website. Is that country is complied with the FATF? If we see just few time back, few year back, the neighboring country, the Pakistan was also under the grey list of the FATF. So if any country is covered under the grey list or blacklist of the FATF, you cannot make the ODI to that country. So before going forward, you have to check and verify the FATF compliance. NOC required from the relevant agency if the Indian entity has account appearing as a NPA, classified as willful defaulter by any bank, under investigation by any investigation agency. So in that case, you have to take the NOC from that particular authority before making the any ODI. If you are going for the NOC and that agency is not giving you the NOC within the time limit, then after expiry of the 60 days, it will be deemed that NOC has been permitted and you can go forward. They cannot give the pending for the uncertain period. Share certificate to be received within the 6 months. So whatever amount you are making outside India, of course, you will acquire the equity shares there. So that share certificate you need to produce and submit to the AD bank within the 6 months from the making the first ODI payment, first ODI remittance. Overseas investment process, create unique identification number. So whenever you will make the payment, you will apply for the payment. You will allotted the UIN from the AD bank side, and all the transactions after that you have to refer and you have to mention that UIN number over the all form for the making the identification and transactions. File ODI form with the AD bank. Schedule E of the ODI form is to be certified by the statutory auditor of the company, who is company or LLP is making the ODI. Check the FATF status on site. Here sites has been given fatf.gafi.org. FATF list out those countries or jurisdiction which are not compliant with that. Bank approve ODI form and then permit remittance. So all the compliances when which are given here, you have to follow that. And AD Bank has also the accountability to cross check, verify, and satisfy himself, and then you can only make the remittance. All remittance through one branch of the AD Bank. So you cannot take the different branch for the bank to handle all this kind of transactions. Only you have to follow the one branch of the one AD bank. If you want to change the bank, then you have to take the NOC from that bank and approval from the RBI also. Only after that you can change your AD. Overseas investment compliance. So every year till investment persists, APR you need to file every year by the 31st December. That will give the status of the investment as name suggested, performance report. It's the annual performance report. In case of the multiple investors from India, highest investor will file in the case of equality to be jointly. So if multiple person has invested in the same entity, then who is holding the highest share, they can only file. And if more than one person is holding the jointly, they can file the joint APR. There is no one issue. APR required to be certified by the statutory auditor in case if that country where you have invested and the audit is not compulsory applicable according to that country law, then here their parent company statutory auditor can certify that balance sheet and can attach with the APR. APR content detail of the foreign entity, shares, capital, net worth, profit and loss, audited accounts of the foreign entity mandatory if control exists, even though not required under the that host country, but they have given some relaxation. And if that country, that host country is not required, the holding company, their parent company, statutory auditor can ratify and sign. Control means authority to appoint director, direct policy, etc. 10% or more holding. Invest by individual. So this is covered under the LRS scheme. LRS is that limit is up to 250 lakhs USD per financial year, applicable to the resident only, resident individual, resident and individual. Both should the criteria should be complied. Purpose of the remittent, acquiring property abroad, acquiring shares of the listed company abroad, opening bank account, disclosure of the foreign assets, signatory in the foreign bank account by the resident. That is also equally applicable under the Income Tax Act. Whatever the foreign assets or foreign bank account you are holding in the any foreign country, as a resident of India, you have to report under the Income Tax Act also. Non-disclosure, it will attract the penalty. Foreign liabilities and assets returns. This is called as a FLA return. It is also an annual return, which is filed by every year by the 15th July. FLA content the basic information about the entity identification, financial results of the Indian entity, their net worth, profit, sales, purchase. So whatever the transactions is made and whatever the assets and liabilities is created over the entity, all the things is reported under the FLA return, which is filed on the FLAIR portal of the RBI by 15th of the July every year. So apart from the FDI ODI, the licensing office, branch and project office is also concept under the FEMA, through which we will also can do the businesses. So under the liaison office, it's a place of business to act as a channel of the communication between the principal place of business or head office. Does not undertake any commercial trading, industry activity directly or indirectly, maintain itself out of inward remittance, permit to carry only permitted activity. So liaison office is set up in the any country uh, by the any foreign entity in the India for the research purposes, for the marketing purposes. You can say they cannot do the business. They can only make the awareness about their product, or they can research what is the market condition. We can uh, penetrate in this market or not. So whatever the liaison office is set up in India, even for their expenditure, they have to bring the remittance from their head office, and also they have to comply with the local laws. They can't do any kind of business, and they have to file the uh, return on the yearly basis to the RBI also. So liaison office has a very limited purpose, and no business activity is allowed through the liaison office. Under the branch office and the project office, any establishment described as a such company, normally branch office should be engaged in the activity in the any parent company. So branch office is a simply, we can say that is the extension of the parent company. So whatever the parent company is doing, branch can do only that function. They can also do the business of that company. Branch has no their legal separate entity. So for the entity basis, their parent will be responsible for the entire things. So branch is just the extension of that foreign entity, and there is no any legal separate entities here. That is also permitted to carry out their the activity by the uh, RBI. Project office is the specific approval for the particular project which was permitted to do in the business for the specified period. So through the project office, that only particular purpose can be done, and for that limited purposes that can be include the business and their representatives also. So this is the basic difference between the liaison office, branch office, and the project office. ECB, earlier ECB was regulated through the 2018 regulation, but RBI has issued the draft ECB regulations in the month of October, on the 3rd October. And recently, in the last week, they have finalized and notified the new regulations, ECB amended regulation 2026. So now this applicable ECB regulations has been applicable, and they have changes lots of things in the new ECB regulations. So what is the main framework for the ECB transactions? So commercial loans raised by the eligible Indian resident entities from the recognized non-resident entity. So here the term eligible Indian resident and recognized non-resident lender, non-resident entity. So both are the important term. So whoever person is taking the or wishes to bring the ECB, that should also be covered under the eligible borrower. And whoever wanted to become as a lender, they have to cover under the eligible lender. So in this revised ECB regulation, they have broadly changed the terms and consider the broad areas as a eligible borrower and eligible lender. So to meet the capital needs as the project finance, modernization, working capital for the overseas investment, ECB can demonetize in the foreign currency as well as INR. So even it is coming from the outside India, the foreign exchange is involved, but it can be in the INR also. That will be also considered under the ECB. ECB minimum average period, minimum average maturity period, MAMP is 3 years, has been given. In some cases, they have also given 1 to 3 year period, some manufacturing industry, and for their certain eligibility criteria. Eligible borrower may raise ECB up to the higher of outstanding ECB up to USD 1 billion or 300% of the net worth of their last audited balance sheet. So this criteria has given in the revised ECB regulations. Earlier it was a different kind of ceiling limits, but now it's a 1 billion or 300% of the net worth. Whichever is higher, they can take the ECB from any eligible lender. So who is the eligible borrower? They have defined also any person resident in India other than individual. So it is clearly mentioned that individual cannot uh, become the eligible borrower for the ECB transactions. That is incorporated, established or registered under the central or any state act is an eligible borrower. So any company, LLP, or even society who is making the businesses, they can also cover under this. And eligible borrower that is under a restructure scheme or CIRP may raise ECB only if specifically permitted under the restructuring. So if any company is undergoing the CIRP process under the IBC Act, so if the resolution plan will be permitted, means LCLT will be approved, then only they can take the ECB. Otherwise, they have to take the finance from the local financial institution only. In case of any pending investigation, adjudication, or appeal against the borrower, then borrower has to disclose in the ECB form when they are filing this form to the ADM. Who are the recognized lender? Who can lend? The lender should be resident of the FATF compliant or IOSCO compliant country, including on transfer of ECB. So who are the not compliant of the FATF or IOSCO? So we can take that example that like North Korea, Iran, Myanmar. So this kind of country is not covered under the recognized lender country. A person resident outside India, they can also become the lender. A branch outside India of any entity business is required to be regulated by the RBI. Any financial institution or branch of a financial institution set up in IFSC. IFSC unit, which is set up under the gift city under the in the Gujarat state. So if any branch is established there and they are giving the loan to the any Indian entity, they will also be considered under the ECB. Both borrower and lender must meet the RBI eligibility norm for the ECB to be valid under the automatic or approval rule. What is the compounding under the FEMA? So contravention is a breach of the following provision, rule, regulation, notification, order. So anything you have make the breach, then you have to go for the compounding. Compounding, meaning of the word compound or compounding not defined under the act or rules. So FEMA has not defined the compounding or compound word. What will be the compounding? Compounding refer to the process of voluntary admitting the contraventions. Means if we did not receive any notices or any uh, So any notice or any demand from the any authorized agency, AD Bank or RBI, but we have voluntarily find out the mistakes, and we now wanted to rectify that. Then we can go for the compounding. It's a totally voluntary process. And what is the benefit? It is a voluntary process, comfort of the citizen and corporate community. Personal hearing is not mandatory, so you can communicate through the over email or through the AD bank also. So you no need to go for the personal hearing. It's not a mandatory case. Minimum transaction cost, time bound within 180 days. In the general cases, compounding will be completed and decision will be made. Changing dynamic of your economic, simple and hassle free, and no procedure for further proceeding initiated or continued. So there is no reassessment kind of things like the income tax. We have made the one assessment, and after few years we found some things and we started the reassessment. So this kind of things is not here. One is finalized. Absolutely, it's closed. Absolutely transparent. So everything is the very transparent manner, and it saves times, energy, and application. So it's a kind of benefit of the compounding if you are selecting for the compounding process. So what will be the process you have to we need to follow? So receipts of the application, receipts of the fees, examination of document by RBI. When we file your application along with the fees, that document will be reviewed by the RBI. Calling for the additional document if required. If they found if any deficiency or any correction is required, they will inform to you. You have to correct and submit the additional document. Opportunity for personal hearing. If required, they will give you up, or you wanted to take the opportunity. You can also write to them. They will provide to you opportunity for the personal hearing. Passing compounding order within the time frame manner. Payment of the compounding amount, whatever the demand or they have prescribed under the compounding, you have to just pay that amount and they will issue the certificate of the payment. This is all from my side. Now we can take the questions.
Yes, a few questions are there. The first question is from Sumalatha Pola. She's asking, does NRI needs to furnish any return if purchase immovable property in India, as there is movement of foreign currency?
No, under the RBI, there is no need to file any kind of return. And we assume that uh, if they have made the transactions, that will be through the legal banking channel, and AD Bank is already informed that.
Another question from Raghava. Can you elaborate the difference of form LLP 1 and LLP 2?
Yes, LLP 1 is filed with the RBI when the person is made the investment in the LLP. And LLP 2 is filed when the person is transferring their share of profit to any other person or they are residing. So any changes is made after the making the investment, then you have to report through the LLP 2 form.
So one question is that what's the benefit of having OCI? How they get privilege over NRI? What's the main difference?
So no, actually NRI and OCI, you need to look the difference between. NRI is the non-resident person and citizen of India. OCI card holder is not the citizen of India. He is also the non-resident, but he is the foreign citizen. But his root is belongs to the India, undivided India. So if they are applying for the OCI card holder, they are eligible because their roots are in the India, and they will acquire and hold the OCI. They get the lots of opportunities. Like they can freely come to the India without any visa. They are freely permissible. They can also make some transactions and investment in the properties in India, like person who is citizen of India, like NRI. but now the non-resident of India. So this is the basic difference. The OCI card holder is not citizen of India, but non-resident NRI is the citizen of India. Both are the non-resident, but the basic difference is that NRI is the citizen of India, but OCI card holder is not the citizen of India.
Citizen. Yeah. But he gets benefit by applying for OCI as a
Yes,
citizen.
definitely they will get the benefit. They have not only the voting rights in the India. Other than that, they have lots of rights as a OCI card holder.
So another question, in the case of repatriation, you said that this amount of foreign currency can be used for paying liabilities and debts. So is netting off allowed? Like for the exports, we are receiving the income, and for imports, we need to pay. So the net off could be repatriate or something like that could be possible.
Yes, that can be possible if you are making the payment or you are transacting with the same vendor. You
Okay.
are bringing some import and making some export to that vendor. So then you don't need to pay the further amount for the import and bringing the amount for the export. You can net off that liability, and accordingly you can make the remittance or bringing that uh, repatriation or remittance can be availed.
There are no further questions till now.
Okay. So I think we have concluded within the time limits.
Yes, sir. So we can conclude with a note of thanks. I, on behalf of the committee, express my thanks to you for giving your precious time and elaborated the topic so clearly and with such detailing. Thank you so much, sir.
Thank you so much, everyone, and all the participants and the committee as well.